This video continues our discussion on accounting for merchandising activities. In the previous video we talked about what a merchandising activity was, merchandisers, wholesalers, inventory, all that kind of stuff. Here we're going to take a look at the actual transactions involved with keeping track of inventory. Essentially there are two kinds of inventory systems that companies use. One called the perpetual system. This is a system where we are continuously updating our system for any goods that were purchased and the cost of any goods that we sell. So we are able to look in our books at any point in time and find out how much inventory do we actually have, the dollar value of that inventory, and the dollar value of anything that we've sold. This is, to be fair, usually a really good estimate of what it is. We don't know exactly what it is until some point in the future, but it's a very close guess and good enough for most of the things we're going to do. The other system is the periodic system, where we don't continuously update the inventory and we don't continuously update an account called cost of goods sold. Here we only periodically check to see how much we have on hand. And some of you may have heard of something called a physical inventory. And a physical inventory just means we go out and we physically take a look at the stuff we have and how much there is on hand. Even with the perpetual system, we have to do that once in a while just to confirm that we haven't forgotten or missed anything. But the perpetual system offers us the advantage of being able to have a pretty good estimate at any point in time the cost of the goods we've actually sold. And it's the preferred method, and now with computerized systems it's much easier to do than it was historically when systems were all updated manually. Traditionally, I will tell you, a perpetual system was usually reserved for people like car dealers, where there were very few sales transactions, very few purchases transactions for things of great value. So jewelers would be another good example. Grocery stores certainly never did that until the advent of computers. Now grocery stores can keep track of every can of beans that goes off the shelf and track at that level. Never could have been able to do that under manual systems, but now computerized they can. Anyway, what we're going to take a look at today, though, is the perpetual inventory system. And here, like I say, we're perpetually updating for anything we buy, anything we sell. And so the accounts involved are pretty straightforward. Let's start this transaction off. We actually purchased some sort of inventory for resale from one of our suppliers. And the entry to record that would be to debit merchandise inventory. This is the account where we keep track of all the things that we've purchased. And we haven't paid the supplier right away. We owe them the money, so we're going to credit accounts payable for that. So we purchased the merchandise on account. So the entry gets posted. We'll use T accounts here to simplify it. Debit to merchandise inventory, that would be a current asset, and accounts payable, a current liability. Now, we may get that stuff and discover that we don't want all of it. Maybe it's damaged, maybe there was a mistake in the order, or for some reason we're sending some of that merchandise back. And this uses something called a debit memo. The reason we call it a debit memo is because we're actually making a debit to accounts payable to reduce the amount that we owe. Obviously, if we send merchandise back to the supplier, we don't owe them as much as we did if we kept it all. And so we see a debit to accounts payable and a credit to merchandise inventory, because now we don't have all $1,200 of that inventory. We actually only have $900 of it left on our shelves, and we only owe the supplier $900. Now, some suppliers will offer us a discount if we pay quickly. It's intended to encourage us to pay quickly. They don't want to wait for their money, and so sometimes they'll give us a bit of a break if we write the check sooner rather than later. So in our case, we're looking at a supplier to whom we owe $900, and they're going to offer us a discount. Just some terminology here. Think about, we purchased some stuff on November the 2nd, and if we pay before the 12th, we'd be entitled to some discount. In this case, a 2% discount on whatever amount you pay. If you pay after that date, they're allowing us up to 30 days to actually pay the bill, in which case we wouldn't take the discount normally if we paid after the 10 days. And we represent that by a 2% discount if paid within 10 days. Otherwise, the net, all of it, is due in 30 days. And you'll see that notation quite commonly on invoices, and certainly you'll see it in some of the exercises you're going to do out of the textbook. So hopefully that kind of explains what those discounts are all about. We may do the same thing for our customers. When we sell something to our customer, we may offer them a discount if they pay quickly. Obviously, we'd like to get our hands on the money sooner rather than later. This isn't free, of course, and in later courses you may find out just how expensive this really is. But what we know is the longer it takes somebody to pay, the less likely it becomes that they will actually pay, and I'd rather be paid a little bit less than not be paid at all. So let's talk about that if we take a discount. So assume that we purchased our stuff with the terms of 2% if we pay in 10 days, or pay the rest in 30. And so we're going to look at two examples here. How much will we have to pay if we actually take the discount? So we owe the supplier $900. So we're going to write them a check, but we're not going to write them the check for the whole $900. But when we're done, we won't owe them $900 at all. So here's when we take the discount, we want the accounts payable to go away. We're paying this off. The question is, how much do we actually have to pay them to relieve that debt or pay off that debt of $900? They're giving us a discount of 2%. So how much are we going to pay? $882. How did we get that? We reduced the amount that we actually pay by the 2% discount. 2% of the $900 being, remember, we got $1,200 worth of merchandise. We sent $300 of it back. So we owed them $900. We take an $18 discount. The check is only written for $882. I want to point out that this $18, this has been, it's a credit to merchandise inventory. When we first recorded that merchandise inventory, we had it recorded as $900, that it cost us $900. But when the dust is all settled here, it turns out that we didn't actually cost us $900. It really only cost us $882. We didn't know that at the time that we bought it. We didn't know for sure if we were going to take the discount, but now that we have, we actually reduced the cost of that inventory by $18. If we didn't take the discount, the entry, of course, would be to reduce the accounts payable and credit cash for $900. And you've seen that kind of entry a number of times before. Chance to practice this, try Quick Study 6-5 and Lyrics 6.2. I want to talk a little bit about the transportation cost. And the terminology we use here is freight in, that is freight in to us. So our supplier is going to deliver our material from them to us, and let's just say that the cost of that freight is $75. Once again, we see that increases the cost of our merchandise. So the merchandise inventory gets debited for $75, therefore increasing that current asset or our investment in inventory and reducing cash by $75. And that's to pay the freight charges on that merchandise. Now, we don't always pay. It kind of depends on what the terms are. And you may see this when you're out doing this sort of thing. It's called the FOB point, or the free on board point. It's an old shipping term. You can Google that or check it out on Wikipedia. But if the terms are FOB shipping point, that means the seller picks up the freight charge from the point of shipping. So, sorry. So you'll notice that if the terms are FOB shipping point, that means that the buyer pays the shipping charges. What the shipping point is defined as the saw-off point between when the seller stops paying and when the buyer starts paying. So the carrier was going to charge somebody $75 for shipping those goods. The question is, who pays? If it's FOB shipping point, that means the seller stops paying at the shipping point and the buyer starts paying. So the buyer would be on the hook for those charges. If it was FOB destination, that's the saw-off point, where the dividing point between when the seller stops paying and the buyer starts. Then in that case, FOB destination, that means the seller pays all charges until it gets to its destination, in which case then the carrier would send the bill to the seller. So now the final step, obviously we've got this merchandise, we'd like to sell it to a customer, and here's where we actually make some money as a business. We sell merchandise to the customer. Terms are 2% if we get a discount in 10 days, net if they pay in 60. So they would pay the whole amount in 60 days. You may wonder what happens if they don't pay it in 60 days, and we may actually start to charge them some interest on their overdue account. But it doesn't become overdue for 60 days. So 2% if they pay in 10. So we sell them some merchandise, and you can tell we've sold them some stuff, and we've charged them $1,000. So we record the sale, credit sales $1,000, and we debit accounts receivable. We'll receive $1,000 from them at some point in the future. Remember, we don't have $1,000 worth of inventory. So even though we sold it for $1,000, you know that it obviously didn't cost us $1,000. There's no point in selling inventory for what it costs you. You don't make a profit. So we sold it for more than it actually cost us. And I'll just tell you, for that $1,000 worth of inventory, it only cost us $600. So the entry then is to get it out of inventory, because now since we've sold it to the customer, we don't have that $600 worth of inventory before. And remember, we either own it or we don't. If we still own it, we call it inventory. If it's not here anymore, we must have sold it. So it becomes part of the cost of the goods sold. So merchandise inventory gets reduced by $600, so now we only have $300 left. And there'll be a debit to cost of goods sold to keep track of the cost of the goods that we've sold. Following through then, hopefully the customer pays us. If they pay within 60 days, what would we expect to see? If they owe us $1,000, we would expect to receive $1,000, and in fact that's what we get. A debit to cash for $1,000 and a credit to accounts receivable. I want you to take a close look here. There's no mention of a revenue account, there's no mention of inventory, and there's no mention of cost of goods sold. This is merely the customer paying what they owe us. We recorded the revenue and we recorded all the elements of the cost prior to this. What happens if the customer pays in 10 days though and we actually get a discount? They actually get a discount. Well, as before, they're not going to write the check for the whole $1,000. They no longer owe us $1,000, so we're going to reduce the accounts receivable with a credit by $1,000. They're only going to send us $980, and that $20 in discounts goes into an account called sales discounts, or discounts on sales. But sales discounts covers it. Some new accounts being introduced here, but remember the descriptions of them, the names on the accounts, offer us some insight into what the account actually keeps track of. The sales discount account keeps track of all the discounts that our customers have taken on payments. Okay? And cash and accounts receivable, these are all the standard stuff. Could happen that a customer would return stuff to us. If they return things to us, now that inventory that we didn't have a minute ago, suddenly we have it back. So try to imagine what this entry is going to look like. We're going to have to increase our inventory again because the inventory has come back to us. Okay, so that's going to be one element of this transaction. We didn't actually make the sale to the customer. Part of that sale has to be undone. So here's what that transaction is going to look like. The first part of it is we're going to keep track of all the returns and allowances from our customers. It's nice to know, since we're always looking for good information, of all the stuff that we sold to our customers, how much of it actually came back. That would be a good number to know. Obviously, if we're getting most of our merchandise back from our customer, we're not doing a very good job. We'd like to get very little, and so we tend to track that number. But the customer no longer owes us for this stuff either. So we reduce the amount that the customer owes us, so the accounts receivable goes down. We're not going to receive as much payment in the future now because they've returned the merchandise. And we debit returns and allowances to sort of undo the sale. But we've got the merchandise back. So there's this other part of this transaction that happens at the same time to record that we've got the merchandise back, and this is a debit, just like when we bought the merchandise. But we didn't buy it, it came back to us, and so the cost of that merchandise gets taken out of our cost of goods sold because we didn't sell it. It sort of undoes part of the sales transaction from earlier on. And again, you can take a practice at this, and we'll look at some examples, but practice QS 6-8, and there's 6.3.